Welcome back to Alpha Recap. I'm so glad you joined us. We're wrapping up the trading day and bringing you the biggest sector moves and takeaways from markets that closed earlier today. As always, if you have questions, you can reach us at stockalpha.ai and ask us anything. I've got Ryan with me. He's an investment advisor and today's expert guide. Great to have you back.
Thanks for having me. Excited to dig into a day that was equal parts thematic clarity and headline drama.
All right, let's start with the big picture. Today felt like a classic split market. Pockets of momentum and pockets that got hit. Tell us how you'd sum it up in one sentence.
In short, tech, industrials, and materials led the way thanks to AI spending and M&A, while utilities, parts of healthcare and crypto lagged because of policy, grid stress, and volatility.
Perfect. Walk me through the top winners first. What stood out in technology and industrials?
Tech was driven by continued AI demand, some standout corporate results and deal chatter. Apple reported record revenue, which helped confidence in the broader tech capex cycle. The Corning and Meta partnership to build a factory, they announced about $6 billion of collaboration, is a good example of how AI drives not only software spending, but real-world manufacturing investment.
That Corning Meta tie-up kept getting mentioned. So that's more than just shiny headlines. It actually points to factories, glass, optics, and the whole supply chain needing to scale, right?
Exactly. When hyperscalers commit capital to physical factories, it creates demand for semiconductor equipment, advanced materials, and even specialized real estate for manufacturing. That's why industrials and materials rallied with tech today.
And energy was another winner. We heard Brent topped $70 a barrel. What triggered that?
A few things. Geopolitical friction involving Iran, plus a Turkish refinery fire that tightened near-term supply expectations, and stronger buying from China. All that pushed Brent above $70 a barrel and helped energy names get a lift.
So, classic supply shock plus geopolitical premium. How did renewables fit into the energy story today?
Renewables had positive headlines too. Companies like SolarEdge and SunGrow showed expansion activity in Europe, and big utilities such as Iberdrola continued to advance large-scale projects. So you had short-term tightness in oil and continued investment in solar and storage, which benefited different parts of the energy complex.
Very interesting. Now, on the other side of the ledger, utilities got hit hard. Tell listeners why that was.
Two big things. First, the Department of Energy rescinded a $1.8 billion loan to Arizona Public Service, which raised flags about political and regulatory risk. Second, the North American Electric Reliability Corporation flagged long-term grid stress, and Winter Storm Fern added operational strain. That mix of policy pushback and weather-driven stress made investors nervous about utility balance sheets and execution.
That loan rescindment was a headline. For listeners who don't live in the world of utility policy, how should they think about that rescindment in simple terms?
Think of it this way. Regulated utilities often rely on predictable policy support and financing for big projects like grid upgrades or new generation. When a major federal loan gets pulled back, it raises questions about whether other projects might face funding or political hurdles. That increases uncertainty, and investors typically punish uncertainty quickly.
Got it. And crypto was volatile today. Bitcoin was trading around $84,000, but had a sharp pullback. What was going on there?
There were continued institutional flows into crypto products, which supported higher prices overall. But intraday, we saw a sharp sell-off that highlighted liquidity and regulatory worries. So you had institutional demand on one side and supply and custody concerns on the other. That tug of war produced big intraday swings.
So, it's not a simple story of institutions piling in and prices only going up. The infrastructure and rules around custody still matter a lot.
Absolutely. For crypto-related equities and structured products, regulatory headlines and exchange bank relationships can quickly widen trading ranges.
Let's hit some of the day's most consequential moves one by one, starting with Brent topping $70 a barrel. What should investors watch next on that front?
Inventory reports, OPEC plus communications, and Chinese buying patterns. If inventories continue to tighten, or OPEC plus signals coordinated cuts, energy equities could see more upside. Conversely, if supply comes back online or demand softens, that rally could reverse.
Next big move, the Corning Meta $6 billion factory. That seemed to light up suppliers and industrial names. For listeners who want exposure, what are practical ways to play that theme?
Look for companies with confirmed contracts or visible order books tied to hyperscaler builds. That reduces execution risk. Suppliers of industrial glass, optics, and semiconductor tools are natural beneficiaries. The key is to buy names where demand is contract-backed rather than narrative only.
StorageMart's roughly $1 billion transaction also got attention. What did that tell us about real estate today?
It showed selective strength. Self-storage, life science headquarters leases, and targeted refinancing deals, like a $160 million refinance that was reported, signaled capital flowing into resilient niches. But the broader real estate story was mixed because of concerns like foreclosures and some policy chatter around retirement account withdrawals.
Speaking of mixed, healthcare was described as split, M&A activity on one hand and regulatory scrums on the other. How did that split play out?
Precision medicine and M&A-driven winners had rallies, but weaker vaccine guidance and Medicare-related debates created pressure on parts of the sector. When policy headlines become front and center, they can overshadow long-term fundamentals, at least in the near term.
You mentioned Japan's box office earlier. That jumped 32% to about $1.8 billion. Fun fact, but is there real market relevance there?
Yes. Strong theatrical results in Japan reflected healthier consumer engagement and helped media and communications names tied to content production and distribution. It's a reminder that pockets of consumer strength still exist, especially in entertainment and ad-driven revenue streams.
Let's step back and look at the cross-sector themes you teased earlier. Start with AI and the physical capex linkage. Explain it as if I'm telling my aunt who thinks AI is just software.
Tell your aunt that AI needs a lot of hardware. Training and running large models requires chips, cooling, specialized glass, and factories to assemble equipment. So when tech leaders commit to AI spending, that money flows to manufacturers, materials companies, and even landlords who lease data center space. In plain terms, software growth is creating a real manufacturing cycle.
Nice. Next theme, energy tightness meets renewables investment. It almost feels like two stories at once.
Exactly. In the near term, oil tightened because of geopolitical events and outages, but at the same time, long-term investment in solar and storage continued. That creates opportunities across subsectors. Integrated energy names benefit from higher prices now, while equipment makers and installers benefit from long-term clean energy demand.
Third theme, policy, reliability, and headline risk in utilities and healthcare. What should investors do about that risk?
Prudence. For income-seeking investors, focus on utilities with low leverage, strong regulatory relationships, and diversified generation. In healthcare, reduce position sizes around policy-sensitive names or use options to hedge. Essentially, manage position sizing and avoid being overly exposed to headline swings.
And capital recycling? Welcome to the M&A party. Why is that important for the broader market?
Active M&A and asset sales signal that managers see opportunities to redeploy capital at attractive returns. That tends to re-rate sectors where deals are happening, like materials, certain real estate niches, and parts of tech. M&A is often a leading indicator of confidence in valuations.
Finally, crypto's dual personality, institutional demand versus supply and regulatory risk. How should folks manage exposure there?
Use strict phasing and risk management. Consider staggered entry and exit, option collars, or hedges. Emphasize custody and liquidity, and avoid concentrated positions unless you have a high risk tolerance and a plan for stress scenarios.
Let's move to actionable investor insights. Short term, what were your practical moves for the next few weeks?
Short term, favor selective cyclicals and AI industrial beneficiaries. Think suppliers with visible order books. Reduce duration in utilities unless you're being paid well and the balance sheet is strong. And hedge or trim concentrated crypto exposure given the volatility around about $84,000 for Bitcoin.
Medium term, what were the priorities for the next quarter to a year?
Rotate into materials and select miners where M&A and production upgrades are visible. Look for high-conviction renewable and storage plays with confirmed orders, and revisit real estate allocations for niches like life science space and self-storage because those showed resilience.
Portfolio construction tips?
Diversify across demand and supply themes. Pair AI and CAPEX exposure with defensive yield holdings to smooth volatility. Use options around regulatory-sensitive names, and keep liquidity to take advantage of dislocations and deal-driven re-ratings.
Any tactical ideas you were keen on after the close?
Buy the strength in AI CAPEX beneficiaries with confirmed contracts. Prefer companies with visible execution and order book visibility. Defensively, favor top-tier integrated energy names or low-leverage utilities as ballast, rather than single-asset explorers or politically exposed utilities.
Before we close, hit us with the top catalysts to watch next, the things that could move markets in the coming days and weeks.
Key catalysts: energy inventory reports and any OPEC plus signals. Further updates from grid operators or the NERC that could increase utility stress. Tech order book announcements and semiconductor CAPEX plans that confirm AI spending. Any crypto regulatory or custody developments. M&A headlines in materials and real estate. And of course, major economic prints and Fed commentary that could shift risk appetite.
All right, Ryan, give our listeners your quick, clear takeaways. 3 bullets, rapid fire.
1. Be selective. Overweight proven beneficiaries of AI and near-term energy tightness. 2. Manage policy and headline risk. Trim or hedge utilities and policy-sensitive healthcare until clarity improves. 3. Keep liquidity and use deal flow as a signal. Active M and A points to pockets of conviction and opportunity.
Fantastic. That was a ton of great color. Any final parting advice for our Alpha Recap listeners?
Stay disciplined on position sizing, focus on execution and contracts over narratives, and be ready to act when liquidity creates dislocations. The market was selective today. Your strategy should be too.
Thanks so much for joining and breaking all that down. Quick reminder to everyone listening, if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. That's stockalpha.ai for your questions and deep dives. Thanks for listening to Alpha Recap, and we'll see you next Market Wrap-Up.